Analysts are telling me that there are more algorithms now trading crypto. That makes some of these moves especially sharp, and there's leverage in crypto markets.
But I think this is just a short-term knee-jerk reaction to what's going on in the market. But we're seeing more and more money pile into buying today.
Same for the next 3 years. Probably there will be some black swan event that we don't even know at the moment that will pop up and change the entire game as we know it. So I think the greed and fear in people will stay. And that's causing the FOMO tops and the crash bottoms. And that's amplified, of course, by leverage. People that lend money to invest in this already very volatile and high return asset, which is very stupid. You should never, ever do that. That's you're certain you take it to hell. You will get liquidated. So I think indeed that it will not be a super cycle just yet, but it will have a FOMO top, and that can be even higher than we might expect, right? Because if we look at this chart, the FOMO top in 2017, the 20,000 was about 3 times above the 7,000, 7,500 model line. So if we would project that on today's stock to flow value of 100,000, you would get a top of 300,000. But then if you look at 2013, it was like 10x above the model line. So that would imply a $1 million top in, say, 2022, which is unthinkable right now. But we did it in 2013 and actually in 2011 as well. So it wouldn't be impossible. But I certainly think that after that, the fear kicks in, something happens, some people take profit or are going to hedge themselves with futures, and the whole thing starts tumbling down and we crash back. We get this high returns because there is high volatility. You cannot have one straight line up, because everybody would be buying Bitcoin and nobody would be selling. I've never seen an asset that does have only upside and no volatility. It's in fact, it's a capital asset pricing model, a famous Nobel Prize winning model that's sort of the center piece of all finance. And that says there is a very distinct relation between the risk and return. So you cannot have the return without the risk. I know why Michael thinks that, because he of course has a lot of experience in investing in high-tech companies, Google and Amazon. That's where he earned a lot of money with investing in those companies. In those companies, the volatility was in the beginning, when the adoption was not clear. But once the adoption kicked in, it was one straight line up. And he thinks the same is true for Bitcoin. I would agree more with you, I guess, that the volatility stays and that Bitcoin is not a company like Google and Amazon, but more like a commodity or a currency, and money in the end. By the way, I do think that we will have a super cycle or hyper Bitcoinization event eventually, when after the next halving we surpass the stock to flow ratio of real estate, stock to flow ratio of 100, then it will become the most scarce asset in the world, and probably also the most valuable asset with the highest market value, above 100 trillion US dollars. And that's where the stock to flow model sort of ends, right? That's where we have no data anymore. We denominate Bitcoin in dollars, but that will probably not make sense anymore at that time. And probably indeed the dollar might be replaced by something else, Bitcoin or the special drawing rights of the IMF or something else. And of course, all the gold investors hope that will be a gold-backed thing, gold-backed world currency. But I think there's a real chance that Bitcoin will be that better money, thermodynamically perfect money. Bitcoin should shift to the denominator of all other assets. And so really, really interesting times ahead. The Bitcoiners are taking over the world. And that will be another interesting thing to watch, the game that the IMF is playing and the emerging markets. So what El Salvador did was very brave, very new. It's a thing you can only do if you have a leader that has a lot of control over the country. But I guess more countries like El Salvador will follow. I heard some stories about Zimbabwe. I heard Brazil was looking at it. There's more. If that ball goes rolling, if more people follow, that could be a huge shift in macroeconomic play, where the IMF will certainly. But of course, those countries are now very small and not real players in the global economy. But yeah, it's very interesting. And then I think the big overarching geopolitical, maybe military thing is, of course, China-US. Always has been a thing, but with the South Sea troubles and now Hong Kong and Taiwan being the next maybe battlefield. Same for the next 3 years. Probably there will be some black swan event that we don't even know at the moment that will pop up and change the entire game as we know it. It says on average it will be 100K in this 4-year period. The chart with the confidence bands is, I think, very clear in that as well. So that means that we have to go, we have spent 1.5 years below 100K. So we will have to spend a considerable time above 100K to make that 100K average. And I think it's not inconsistent with that dark blue area should be populated with 67% of the bullets of the monthly closes in that halving period. And also for the confidence bands, I think we should not spend, like Safe said, a lot of time, like 6 months or more, something like that, far above or far below the 2 standard deviation band, because that's also not compatible with the model. So the November estimate is 98,000, and December is 135,000. And I didn't give any predictions after that because it's a very short-term thing. It's not like stock-to-flow ratio that I can expound that into in the future for a year or 2 years, even 10 years. So let's first see those two. And the reason that I can give those two, or actually the last 3 as well, so 5 months in advance, is because we are exactly at this lower floor at the moment. I know we cannot go below it. Theoretically we can, but then the model, of course, is broken. But because we are at the bottom, I can extend it a little bit into the future. And as soon as we are going to start getting prices above the floor model, then I cannot extend it anymore. I know that sounds like a bit of a mystery, but I did, of course, not publish the model yet. So, but that's what it is. And it's completely different model than the stock-to-flow model, because it's not based on stock-to-flow ratio. It's based on technical analysis, that is price only input. So if it fails, it's too bad, but it doesn't say anything about the stock-to-flow